Okay, let's unpack this. Welcome to the Deep Dive, the show where we take the most complex, jargon-heavy documents, financial regulations, legal statutes, economic research, and we try to transform them into clear, actionable knowledge.
And our deep dive today is, well, it's perhaps one of the most universally relevant topics to anyone who deals with money. And yet, I think it's still one of the most misunderstood. We're talking about the tax deduction.
Yeah.
We're moving beyond that superficial definition and really diving into the detailed and sometimes pretty surprising world of tax deductions, exemptions, and credits using our source material as the guide.
When you even mention the words tax deductions, I think most people's eyes just glaze over.
Yeah, they do.
They think of paperwork, audits, accountants.
But fundamentally, what we're talking about is the core mechanism that defines the difference between the total money you make and the much smaller amount of income the government actually gets to tax. Our mission today is to understand that difference. Exactly. And to start, we really have to nail down some definitions because tax systems all over the world offer multiple ways to reduce your liability, and structurally, they are just not all created equal.
Okay.
Our sources clearly outline three distinct types of tax incentives. You have deductions, exemptions, and credits. Now, while deductions and exemptions are often sort of treated the same in common speech, they both reduce your income. A credit is an entirely separate animal.
Okay, here's where we get that crucial aha moment right out of the gate, I think. Can you just break down for us the difference between reducing your income versus reducing the actual tax?
Absolutely. So deductions and exemptions, they both work to reduce your taxable income. Imagine you earn $100,000 and you qualify for, say, $15,000 in deductions and exemptions. That means you're only taxed on $85,000.
Okay, so it's a proportional benefit. The value of that $15,000 deduction really depends on my tax bracket.
It depends entirely on your marginal tax rate. So if you're in the 35% tax bracket, a $1,000 deduction saves you $350 in actual tax.
The benefit is indirect.
It's indirect, precisely. Now, a tax credit, that operates completely differently. It is a direct subtraction from the actual amount of tax owed, dollar for dollar. So if you calculate that you owe $20,000 in tax to the government and you have a $2,000 tax credit, you just pay $18,000. Simple as that.
That is a massive structural difference, isn't it? A deduction is worth a percentage of its face value, depending on my bracket. A credit is worth 100% of its face value, no matter what. It's an immediate guaranteed saving against the final bill.
It is, which is why credits are, universally preferred from the taxpayer's perspective. And governments often use credits for maximum policy impact to encourage things like installing solar panels or adopting a child.
Yeah.
But deductions, they're far more common, especially when we're dealing with the costs of making money. Deductions define your economic reality. And to really understand their complexity, we first have to talk about this fundamental concept of the line.
Okay, let's unpack this foundational concept of the line. It sounds almost, mythical, but it determines the hierarchy and the effectiveness of every single deduction we take. We're talking about the calculation of adjusted gross income, right? AGI.
AGI is the hinge point of the entire individual tax system, especially in the U.S., which is, heavily referenced in our source material. AGI is so critical that on the 2017 U.S. 1040 tax form, it was specifically labeled as Item 37. It's the number you get to after you take your first set of deductions from your total gross income.
So the line divides deductions into two very distinct camps. You've got above the line and below the line. Let's start with the gold standard. What makes a deduction fall above the line?
So deductions that are taken above the line are subtracted directly from your gross income,
Yeah.
and that reduces the AGI immediately. These are universally available, and they're automatically useful no matter how you handle the rest of your taxes.
Right.
The sources cite interest paid on student loans as a classic example of an allowed deduction that usually falls into this camp.
And what makes reducing AGI so powerful? Why is lowering that initial baseline number the gold standard here?
Well, the reduction of AGI is so significant because AGI is used all over the tax code as the baseline, the denominator, for figuring out limitations and thresholds and phase-outs on practically every other tax provision. A lower AGI can be the difference between qualifying for a tax benefit and not.
Wait, can you walk us through a quick scenario where AGI is that hinge point?
Certainly. Let's take medical expenses. In the U.S., medical expenses are only deductible if they exceed a certain threshold. Let's say it's 7.5% of your AGI. So if your AGI is $100,000, you have to spend $7,500 in medical expenses before you can deduct a single penny.
Right, you have to clear that hurdle first.
You have to clear the hurdle. But If you had $10,000 in above-the-line deductions, things like student loan interest, self-employment tax, IRA contributions, your AGI drops to $90,000. Now, your threshold is only $6,750.
I see.
So by lowering your AGI with those initial deductions, you've made it significantly easier to clear that threshold and then claim the subsequent deduction for your medical costs.
So those above-the-line deductions are just inherently more useful because they have this ripple effect through the rest of the tax calculation. They make everything else that follows more valuable. That's a key insight for you.
It really is. Now, for the deductions below the line, this is where the standard deduction comes in as a major gatekeeper. These are what we commonly call itemized deductions. And they only lessen your final taxable income if their combined total amount is more than the predetermined standard deduction.
This highlights a really fascinating policy trend we've seen in recent years, right? The idea of increasing the standard deduction to simplify taxes for most people. Our sources give us some real numbers here, referencing the U.S. 2018 tax year.
They do. The standard deduction was $12,000 for a single taxpayer and $24,000 for a married couple filing jointly.
Okay, so take that married couple with the $24,000 hurdle.
Right. So they might have paid $15,000 in mortgage interest and maybe $5,000 in charitable giving. That's $20,000 in itemized expenses.
Right. Real money out of their pocket.
Real money. But those expenses are functionally useless for tax purposes because they didn't clear that $24,000 hurdle. They're better off just taking the fixed and pretty generous standard deduction. They only benefit from itemizing if their expenses total $24,001 or more.
It's the ultimate either-or choice. You either take the fixed amount or you gather up all your receipts and try to beat it. And the higher that standard deduction gets, which is often sold as simplification, the less relevant those specific, targeted, below-the-line incentives become for the average person.
That's absolutely right. And it kind of segues into a general limitation we see across many tax systems. Deductions generally require that the expense produces a current benefit. If an expense is going to produce benefits way out into the future, like buying a new building or developing a patent, it's usually subject to capitalization rules.
Spreading the cost out over time.
Spreading it out, exactly. But for now, the fundamental goal is simple. Matching your current expenses to your current income to accurately figure out that profit number that's subject to tax.
And that idea of matching expenses to income brings us right into the world of business. This next section focuses on the core engine of deductions. Business expenses. I mean, nearly all tax systems allow deductions for expenses you incur in running a business.
Right.
Taxing gross revenue would just be economically catastrophic.
It would be.
But what actually qualifies as a legitimate business expense, that's where the definition starts getting really scrutinized.
Indeed. The criteria are strict, but they also differ, sometimes fundamentally, depending on the legal system you're operating in. What's fascinating here is the definitional split between a system like the UK and one like the US.
Okay, walk us through that difference in philosophy.
Well, the UK approach tends to focus on tax levied on chargeable profits of a trade. What this means is that the calculation of what's deductible is heavily governed by local, generally accepted accounting principles, or GAAP.
So if your accountant says it's a valid business expense, the tax authority generally agrees.
That's the strong starting point. It relies on the commercial judgment that's reflected in the financial statements. The U.S. approach, on the other hand, is codified very specifically in the tax code itself. It allows, as a deduction, all the ordinary and necessary expenses paid or incurred in carrying on any trade or business.
That language seems simple, but I'm guessing it's not.
It's deceptively simple. That one phrase has required, over 100 years of judicial interpretation to define what it actually means in practice.
Okay, so let's unpack that central U.S. requirement. It seems to set two separate hurdles. First, you have to qualify as a trade or business, and second, the expense has to be ordinary and necessary. So what defines a trade or business in the eyes of the tax authorities?
The courts have established a few major criteria that have to be met. The activity must be regular, continuous, and substantial. And this is the big one. It has to be entered into with a genuine expectation of profit. All those elements generally have to be there.
That expectation of profit part seems like the most crucial and probably the most fought-over point, doesn't it?
Absolutely. This is the government's main tool for preventing abuse. It's often called the hobby loss rule. If you own a luxury yacht and claim to run a charter business, but you show losses year after year after year, the IRS might come in and argue you don't have a genuine expectation of profit.
And then what happens?
The activity gets reclassified as a hobby, and the deductions are severely limited. They're often only deductible up to the amount of income the hobby generates.
So if I spend $50,000 running my little boutique vineyard, but I only sell $5,000 worth of wine, if the government calls it a hobby, I can only deduct $5,000, even though I genuinely spent $50,000.
Exactly. It's an effective way to stop people from turning their personal consumption into a tax write-off. The courts look at all sorts of factors to gauge that profit motive. How you carry on the activity, your expertise, the time and effort you put in, your history of income or losses. It requires a demonstrable effort to try and make money.
Okay, so that's the first hurdle. What about the second one? Ordinary and necessary. The expense itself has to be appropriate to the business.
Right. The phrase ordinary and necessary ensures both appropriateness and purpose. Ordinary doesn't mean it happens all the time. It means the expense is common or acceptable in that specific type of business.
So if you run a fishery, buying nets is ordinary.
Exactly. But if you run a software company, buying nets is definitely not ordinary. And necessary means the expense is appropriate and helpful in generating income. But, and our sources really emphasize this, the expense must not be lavish and extravagant.
That's the tax authority stepping in and imposing a standard of reasonableness. So I can deduct the cost of my work truck, but I probably can't deduct the cost of a diamond-encrusted helicopter just because I occasionally use it to fly to a client meeting.
It's basically the government saying, look, we'll subsidize the reasonable costs you need to generate taxable income, but we are not going to subsidize your excessive personal luxury disguised as business. And that reasonableness standard is applied to everything, salaries, travel, you name it.
It's important to remember these rules apply across the board, right? We're talking about the same kinds of expenses: salaries, rent, utilities being deductible for a huge multinational corporation and for an individual just starting out.
Right. And we should quickly touch on flow-through entities, things like partnerships, S-corporations, and trusts. In these structures, the entity itself doesn't pay the income tax directly. The income and expenses just flow through to the owners or the beneficiaries.
So the business expenses just reduce the net profit that flows through.
Generally, yes. The operating expenses retain their character as part of that profit or loss calculation. But there are exceptions where the character can change.
Such as?
Charitable contributions, for example. If a partnership makes a charitable gift, that's generally not deducted at the partnership level. It passes through to the individual partners, but it often converts into an itemized deduction for them.
So it's subject to all those personal limitations we're going to talk about later.
Exactly. It ensures that the government's policy goals for charity are still enforced at the individual level, even if the gift came from a business structure.
That distinction, between what's a legitimate business expense and what isn't, is fundamental. But even after an expense is deemed ordinary and necessary, business owners have this immediate classification problem, distinguishing between general operating expenses and the cost of goods sold, or COGS. It's not just one big bucket of deductions.
You've hit on a really critical point. COGS is, it might be the single most important expense deduction for any business that deals with inventory. Manufacturers, retailers, wholesalers. Nearly every tax system, whether it follows JAP or specific tax codes, allows a deduction for COGS.
Conceptually, it makes perfect sense. I should only be taxed on the profit I make after I recover the cost of the actual item I sold. But what are the underlying pieces of COGS?
COGS essentially includes all the costs that are directly attributable to the production of the goods or services you're selling. So that's raw materials, freight, storage costs, direct labor, factory overhead. And importantly, COGS is sometimes treated as a reduction of gross income, not a deduction in the traditional sense, but the effect on your net taxable income is exactly the same.
And the crucial rule here is no double dipping, right? If you include the rent on your factory floor as part of your product cost in COGS, you cannot then deduct it again as a separate operating expense.
Precisely. But our sources really highlight that the accurate determination of COGS involves immense complexities, especially in large-scale operations. They list 4 big inherent difficulties. First, assigning costs when you can't specifically identify them. Second, allocating common costs. Third, the timing of when you recognize the cost. And fourth, recognizing when your inventory loses value.
Okay, let's focus on that first one, assigning costs. If I'm a global oil distributor and I have millions of barrels of crude oil that I bought at different prices over the last year, all sitting in my storage tanks, how on earth do I determine the cost for the specific oil I sell today?
Well, since specific identification is impossible, accountants have to rely on inventory accounting conventions. The three most common are first in, first out, or FIFO, average cost, and last in, first out, or LIFO.
FIFO assumes the oldest stuff is sold first.
Mhm.
LIFO assumes the newest stuff is sold first.
Right, and this is where policy really meets profitability. LIFO is particularly beneficial during inflationary periods because you're assuming that the most expensive, most recent inventory is what you sold first. That leads to a higher COGS, which in turn leads to a lower taxable profit.
So it's a way to defer taxes when your costs are rising.
That is the core insight. LIFO allows for some pretty aggressive profit deferral and lower tax payments when costs are going up. And this is exactly why the source material specifically mentioned that many EU countries actually prohibit LIFO accounting entirely.
Really?
Yes, they mandate adherence to FIFO or average cost methods. This isn't just an accounting choice, it's a political decision designed to curb what they see as aggressive tax deferral and ensure more consistency with international reporting standards, which also don't like LIFO.
Fascinating. So the tax authority is regulating the very accounting method used to calculate profit to stop what they deem to be excessive manipulation.
Absolutely. The second complexity you mentioned is attributing common costs, like factory overhead. If your factory uses electricity, that cost has to be allocated across all the different products you're making. This involves methods like standard costs or more complex activity-based costing.
And timing is the third complexity. When do I recognize the cost? Cash method? Accrual method? Does the tax system dictate this?
It dictates it heavily. Tax methods for cost recognition can be very different from GAAP. For example, tax law might let you immediately expense certain startup costs that GAAP would require you to capitalize. The rules on cost recognition are paramount for an accurate profit calculation.
And the fourth complexity you mentioned relates to declining value, so inventory that you know you won't be able to sell at its full cost.
Correct. Accounting standards generally let you recognize that declining value. If the market value of your inventory falls below what you paid for it, you can sometimes use the lower of cost or market value principle. This adjusts your COGS calculation upward, giving you an immediate deduction for that anticipated loss.
So you don't have to wait until you sell it for cheap years later to get the tax benefit.
Exactly. It ensures a business isn't forced to wait to recognize that its inventory has diminished in value.
This brings us to a really crucial point. Even if an expense is ordinary and necessary, and it's properly classified as a regular operating expense, the tax system frequently imposes its own limitations, or just outright says no. This is where tax law stops just measuring income and starts actively enforcing public policy.
This catalog of restrictions is extensive, and it really proves that the tax code is an active instrument of governance. The government is effectively saying, we recognize this is a cost of doing business, but we are not going to subsidize this particular activity.
So give us the highlights. What are some of these specific limitations that really reveal that policy intent?
Well, the sources reference several. We see maximum deductions set for the use of automobiles, for instance, which limits the tax relief businesses can get on luxury vehicles. There are also severe limits on deducting the compensation paid to certain key employees, as laid out in the U.S. Code.
Let's dig into that for a second. The executive compensation limit. What's the policy goal there?
The goal is to discourage what is seen as excessive executive compensation. Traditionally, this limit capped the deductibility of compensation for the CEO and a few other top executives at $1 million per person.
So if a company pays its CEO $10 million, $9 million of that is just not deductible for the corporation.
Generally, that's right. It's a direct government lever trying to influence corporate governance and rein in what some see as runaway C-suite pay.
What about lobbying? The sources mention limits on lobbying expenditures, too.
Right. Expenses for lobbying or other political influence efforts are largely non-deductible. The government essentially refuses to subsidize a business's attempt to change its own laws. And then there's a universal rule. Payments that violate public policy, like criminal fines or penalties, are absolutely non-deductible.
The tax code shouldn't reduce the sting of breaking the law.
Exactly. One restriction that has seen a massive shift recently is business entertainment.
Yeah, talk about that.
Historically, business meals and entertainment faced severe limits. Often only 50% was deductible to stop people from mixing too much personal pleasure with business. However, the sources note a specific exception that temporarily or sometimes permanently removed this limit for business meals in certain tax years, like 2021 and beyond.
A clear economic stimulus, right?
Yeah.
Trying to help the struggling restaurant industry.
A perfect example of how quickly the tax code can be weaponized for economic policy. Now, beyond specific expense types, the U.S. system also limits deductions based on the type of activity, especially passive activities.
Okay, can you elaborate on the passive activity limitation?
This provision was specifically designed to kill tax shelters. Before the mid-'80s, wealthy taxpayers could invest in ventures like equipment leasing or certain real estate deals where they had little to no participation, but which generated huge paper losses through things like accelerated depreciation.
So someone could be a doctor or a lawyer making $500,000, and they could use a massive paper loss from a rental property they rarely even visited to wipe out the tax liability on their professional income.
That's the classic example. The passive activity loss rules put a stop to that. They state that deductions from these passive activities can only offset income from other passive activities.
Ah, so they can't cross over.
They cannot cross over to shelter your active earned income. The losses can be suspended and carried forward, but they stay in their own lane, which maintains the integrity of the tax base on earned income.
That makes a lot of sense from a policy standpoint. Now let's get to that truly remarkable story that illustrates the tension between pure tax theory and public morality. The Australian drug dealer case.
The Commissioner of Taxation v. La Rosa case is legendary in tax circles. So Mr. La Rosa was a heroin dealer. During a drug deal, a large sum of money was stolen from him.
Yeah.
He then argued that since drug dealing was his trade or business, which he entered into with an expectation of profit, the money that was stolen was a loss incurred in the course of that business, and therefore it should be a deductible expense.
Wait a minute. The court actually accepted that an illegal activity, selling narcotics, could be considered a trade or business for the purpose of calculating taxable profit.
Initially, yes. The Australian Federal Court recognized that the purpose of the tax law was simply to arrive at the net profit. And if an expense or a loss was incurred while generating that taxable income, even if the activity was criminal, it should, theoretically, be deducted to arrive at the true net income subject to tax.
Wow. That's a purely logical application of income theory, completely divorced from morality.
It is. It's the ultimate unintended consequence.
So how did the government respond to the optics of subsidizing a drug dealer's operational losses?
The response was swift and absolute. In 2005, the Australian government amended its legislation to explicitly remove deductions for any expenses incurred while conducting criminal business activities. This legislative override is a perfect example of tax law evolving in real time to align with public policy and morality, even when it violates that pure economic logic of how you calculate income.
We mentioned earlier that if an expense provides future benefits, you can't take the deduction right away. The cost has to be capitalized. This is Section 5, where we talk about long-term investment and cost recovery. It's all about spreading that deduction out over time.
This is a cornerstone of both financial reporting and tax accounting. It's the principle of matching. If an asset helps you produce revenue for 10 years, its cost should be matched against the revenue it helps produce over those same 10 years. The capitalization requirement is mandated for assets like plant and equipment, and also for costs related to developing intangible assets.
So buying a ream of paper for the office is an immediate deduction. But if I buy a specialized $1 million milling machine for my factory that I expect to use for 2 decades, I have to capitalize that $1 million.
Exactly. You record it as an asset on your balance sheet, not as an immediate expense on your income statement. This also applies to costs for developing things like a patentable invention.
Okay, so once a cost is capitalized, the tax system provides these formal mechanisms for recovering that cost over the asset's useful life. What are those mechanisms called?
We use 2 main terms for the systematic cost recovery: depreciation for tangible assets and amortization for intangible assets.
Let's dig into depreciation for a second. We're talking tangible assets here, like machinery, equipment, commercial buildings. How is that cost recovery period determined?
Under systems like the one in the U.S., the cost is recovered over an estimated useful life, which is often assigned by the government. The government dictates these lives based on the asset type and the business sector using it. This removes subjectivity and ensures consistency.
And there are different ways to calculate the annual deduction, which can really affect a business's reported profit, especially in the early years.
Correct. The annual depreciation deduction can be computed using the straight line basis, which just spreads the cost evenly across the asset's life. Simple, predictable. Or systems like the US permit using a declining balance basis, like 200% or 150% declining balance.
And what's the benefit of that declining balance method?
It front loads the deduction. It allows businesses to claim much larger deductions in the earlier years of the asset's life, which provides immediate cash flow benefits.
I see.
However, the U.S. system typically requires taxpayers to switch from the declining balance method to the straight line method in a specific year. This just ensures the entire cost is precisely recovered by the end of the asset's life. It's a method designed to accelerate deductions while still maintaining that systematic recovery.
How does amortization for intangible assets differ?
Amortization is the same idea, but for things like patents, copyrights, or acquired goodwill. It's often computed on a simpler, straight-line basis over the expected life of the intangible or a government-specified life, often 15 years in the U.S. for certain acquired intangibles.
I see our source material references capital allowances as an alternative approach used in some systems, like the UK and Canada. How are these different from U.S. depreciation?
Capital allowances are meant to simplify the process significantly. Instead of requiring complex depreciation schedules and switchover calculations, these systems just allow a fixed percentage or dollar amount of cost recovery in specific years, determined strictly by the type of asset or business. For example, the Canadian system has over 30 classes of assets, each with a predetermined recovery percentage.
So it's an effort toward administrative simplicity.
It is. And finally, we should mention costs that are capitalized but often stay non-recoverable until the asset is actually disposed of. Things like cost to form a corporation or certain acquisition expenses, they might be capitalized without any potential for recovery through depreciation or amortization.
So the cash goes out the door now, but the tax benefit is deferred indefinitely, maybe until the business is sold or closes down.
Right. Unless, as the source notes, the tax system specifically allows for an election to amortize some of those costs, like organizational costs, over a set period, which some jurisdictions do to encourage new business formation.
We've spent a lot of time focused on business and calculating profit. Now, let's shift our focus to the individual taxpayer in Section 6. Tax systems also provide relief for personal circumstances and, non-business income generation like investment activities.
This is where the rules become a really complex hybrid. While the systems recognize the costs of managing non-business income-producing assets, so paying an investment advisor or maintenance on a rental property, they impose very tight controls on any losses.
So if I sell an income-producing asset, like a stock or a rental property, for a loss, how does the system treat that deduction?
Many systems will allow that loss, but they limit its deductibility. They often restrict it to offsetting gains from the same class of assets. In the U.S., a loss on the sale of a non-business income-producing asset is typically a capital loss.
Okay.
And you can generally only use that loss to offset capital gains you realized that year, plus maybe a very small amount of ordinary income.
So I can't use a $50,000 loss on my rental property to shelter my $100,000 salary.
Correct. And furthermore, the sources highlight a really critical distinction for you. A loss on the sale of a personal residence, your car, jewelry, or any other purely personal asset is generally not deductible. You can't just deduct a loss because your personal investment didn't work out.
Unless the loss is involuntary, like a fire or theft.
Exactly. If a personal asset is destroyed in a fire or it's stolen, that involuntary loss may be deductible, but it's subject to some very specific, often restrictive rules about insurance and thresholds. This really reinforces that separation between market risk, which you bear personally, and involuntary disaster.
Okay, now let's move to the fixed breaks that the government provides to every taxpayer, even if they don't have a shoebox full of receipts. Personal exemptions and allowances.
These are fundamental social policy tools. They're fixed amounts designed to protect a baseline level of income from being taxed, essentially representing the assumed basic cost of living. The U.S. system, for instance, historically had personal exemptions for the taxpayer and their family. The source cited $36.50 for 2009. The U.K. has a similarly personal allowance, which was over £6,000 in 2009.
And these amounts are incredibly important for low and middle-income families, making sure that subsistence-level income isn't taxed. But they aren't available to everyone, are they?
That's the targeting mechanism at play. Both the U.S. exemptions and the U.K. allowances are often phased out for individuals or couples whose income gets above certain high levels. As your income rises, the benefit of that basic living deduction is systematically withdrawn, directing the subsidy toward those who need it most.
Now let's go back to those itemized deductions, the famous below-the-line list that has to beat the standard deduction. These aren't arbitrary. They are the government's catalog of behaviors it wants to encourage. What specific categories does the U.S. system detail?
The list is very instructive because it really reveals the intent behind the tax policy. So you've got, first, medical expenses, but only deductible above a high threshold, 7.5% of AGI.
Yeah.
This is relief targeted at catastrophic, not routine, medical costs.
Okay.
Second, state and local income and property taxes, the SALT deduction. This acknowledges that local taxes reduce your ability to pay federal tax, though in recent years this has faced caps, making it a very politically charged issue.
Right.
Third, interest expense, specifically on certain home loans. This is a massive subsidy designed explicitly to incentivize home ownership. Fourth, charitable contributions, gifts of money or property to nonprofits designed to outsource some social welfare to the private sector.
And there are others too, right?
Yes. Fifth, retirement or health savings contributions, like to 401ks, IRAs, HSAs. This is a huge policy push for individuals to fund their own retirement and health care. And sixth, certain educational expenses, again reflecting a policy goal of increasing human capital.
It's crystal clear that these are the levers the government uses to encourage people to save, buy a house, be charitable, and pay their local taxes.
And finally, there's this unique category of payments that are deductible by the payer because they become taxable to the recipient. The prime example in the U.S. is alimony.
So the deduction just shifts the tax burden. When I pay alimony, I get a deduction for it, but my former spouse has to report that as taxable income.
Exactly. It's called tax symmetry. The net revenue to the government is maintained, but the tax incidence just shifts to the person receiving the funds. The system requires, at a minimum, reporting of those amounts and often mandates withholding tax by the payer just to make sure the recipient fulfills their tax obligation.
We've covered the individual and the single business in pretty exhaustive detail. Now, for our last section, let's zoom out and look at how these rules apply across massive corporate structures and international borders. This is where deductions really start to impact global economics.
Stepping back to that bigger picture, corporate groups often need ways to handle losses and expenses across their affiliated companies, especially when they don't file a single consolidated tax return. This brings us to the concept of group relief.
Okay, define group relief for us and explain how it's different from just consolidating all the company's books into one.
So group relief is a mechanism where one company, let's call it Company A, is allowed a tax deduction for the expenses or losses that were generated by an affiliated, commonly controlled company B. It allows the loss of a struggling subsidiary to immediately offset the profits of a successful one without requiring the complex legal step of creating a single consolidated tax entity. It gets you the same economic result through a targeted tax deduction mechanism.
Why is that so important, especially across borders?
Well, consolidation across international borders is an administrative and legal nightmare. Group relief simplifies the process. The source mentions a really significant example where group relief may even be available for companies in EU member countries for losses incurred by group companies in other EU countries.
So a UK parent company could benefit from the losses of its French subsidiary.
Precisely. It's an effort to harmonize tax policy within a common market. However, when you're crossing international borders, the default position is usually one of high scrutiny and major limitations on deductions.
And I'm assuming this is where governments are trying to stop corporations from artificially moving their profits out of a high-tax country and into a low-tax haven.
That is the absolute driving force. Many national tax systems impose severe limitations on tax deductions paid to foreign parties, especially if those parties are related entities like sister companies or subsidiaries controlled by the same parent. This is directly tied to the concepts of international tax and transfer pricing that are mentioned in the source material.
Okay, so let's clarify transfer pricing. What deduction is being scrutinized here?
So imagine a U.S. company develops some technology. It then sets up a subsidiary in a low-tax country, say Ireland. The U.S. company then pays that Irish subsidiary billions of dollars in royalty fees for the use of its own technology.
Right.
The U.S. company claims that royalty payment as a massive deduction in the U.S., wiping out its U.S. profit and shifting that profit base over to Ireland, where the tax rate is much lower.
So the U.S. government loses the tax revenue, and the company wins by exploiting that deduction.
And transfer pricing rules are designed to stop that. They require that payments between related parties, like that royalty fee or an interest payment, must reflect an arm's length market rate. It has to be what an unrelated, independent third party would have paid. If the royalty fee is deemed excessive and not commercial, the government will disallow the deduction on the amount that exceeds that arm's length standard. These limitations are absolutely vital for protecting the tax base in a global economy.
So what does this all really mean? We started this deep dive by moving past that simplistic idea of a deduction, and we realized we had to first define that critical difference between a deduction, which reduces taxable income, and a credit, which reduces the tax bill directly.
We established the structural foundation of the whole system, that divide created by the adjusted gross income, or AGI. We learned why above-the-line deductions are inherently superior because they can unlock other tax benefits, and how the high standard deduction acts as this major filter for below-the-line itemized deductions.
Our journey into the business world revealed those strict constraints on deductibility. We contrasted the UK's gap-based trade system with the US's highly interpreted ordinary and necessary test. And we saw that to be a legitimate business, you have to have a genuine expectation of profit. That's the critical antidote to the hobby loss problem.
We dissected the incredible complexity of calculating cost of goods sold, and we recognized the policy implications that are embedded in inventory methods like LIFO and FIFO. And we cataloged how specific government limitations, from executive pay caps to passive loss restrictions, use the tax code to enforce public policy and prevent these manufactured tax shelters.
That led us through the Australian heroin dealer case, where moral policy ultimately had to override pure tax theory. And we outlined that essential concept of capitalization matching long-term expenses like plant and equipment through mechanisms like depreciation and amortization.
And finally, for the individual, we saw that personal deductions are not random. They are intentional policy levers. From the use of fixed personal exemptions to the highly specific thresholds on itemized deductions, like that 7.5% AGI floor for medical expenses or the home mortgage interest deduction, the tax code is actively steering social and economic behavior.
Which brings us back to the core insight from all of this. Tax deductions are so much more than just a calculation method. They are a deliberate mechanism of fiscal policy designed to promote, to subsidize, or to restrict specific actions.
Which leaves us with a final thought for you to chew on, based on everything we explored today. Since deductions are often subject to conditions that influential parties want to encourage, like that medical relief or charitable giving we detailed, how does the modern shift toward increasingly high standard deductions affect the efficacy and maybe even the political viability of those highly targeted incentives?
Right. If fewer and fewer people are itemizing, are those specific policy goals like encouraging significant charitable giving or saving for catastrophic health costs still being effectively subsidized by the government through the tax code? Or is the benefit just becoming generalized and diluted? When tax simplification removes the need to itemize, what's the trade-off in terms of that specific behavioral encouragement that those deductions were originally created for? Something to consider as you review the interplay between policy and profit.
We hope this deep dive helped clarify the complex, powerful, and often surprising world of the tax deduction. Until next time.